Getting business funding is not about luck, connections, or pitching skills. It is about whether lenders can trust your business on paper. Most business owners work hard but never become fundable because their business credit foundation is weak or invisible. In this video, you'll learn how to build business credit the right way, step by step. Step number 1. Creating a lender-verified business identity. Business credit always begins with identity. Before any lender looks at credit activity, they verify whether your business is real, stable, and separate from you personally. Start by registering your business as a legal entity instead of operating informally. A structured entity creates separation and reduces personal risk in the eyes of lenders. Next, apply for an employer identification number directly from the tax authority. This number becomes the backbone of your business credit profile. Open a dedicated business bank account and route all income and expenses through it. Avoid mixing personal transactions. Lenders study account age, deposit consistency, and spending patterns to judge stability. Use a real physical business address that remains consistent across all records. Frequent address changes raise red flags. Set up a professional business phone number listed under your company name. Lenders often verify this during application reviews. Create a basic website with clear services, contact details, and a matching domain email. Free email services reduce credibility. Ensure your business name, address, and phone number match exactly across your bank, registrations, website, directories, and tax records. Even small mismatches can cause automated denials. Register your business with major business data providers so your profile exists in credit databases. Obtain all required licenses and permits for your industry and location. Missing documentation often stops funding silently. Finally, organize basic records such as invoices, contracts, receipts, and statements. This identity setup tells lenders your business is real, traceable, and ready for credit. Step number 2. Opening and managing starter business credit accounts. Once your business identity is properly set up, the next step is to create actual credit activity that lenders can see and evaluate. Business credit does not build automatically. It must be triggered intentionally using the right type of accounts in the right order. Start by opening vendor accounts that report payment history to business credit bureaus. These are suppliers that allow you to buy now and pay later. Choose vendors that approve businesses with limited or no prior credit history. Use these accounts only for genuine business needs such as office supplies, shipping materials, or basic services. When approved, place small purchases instead of large orders. Pay every invoice early, not just on time. Early payments signal low-risk behavior and demonstrate strong cash control. Avoid carrying balances longer than required. Use each account regularly but responsibly. Inactive accounts do not build strong credit signals. Consistent monthly activity with full repayment creates a positive pattern lenders trust. After several successful payment cycles, apply for a business credit card designed for early-stage businesses. Use it for predictable expenses such as software, fuel, or utilities. Keep usage low compared to the available limit. High usage ratios reduce perceived stability. Never miss a payment. One late payment can damage months of progress. Set automatic reminders and calendar alerts to avoid mistakes. Monitor your business credit reports regularly. Check for errors, missing accounts, or incorrect payment statuses. Dispute inaccuracies immediately because lenders rely on these reports for decisions. Avoid applying for too many accounts at once. Excessive applications signal desperation and increase denial risk. Space out credit applications and focus on quality, not quantity. This stage creates visible proof that your business can borrow responsibly, manage obligations, and repay reliably. Without this step, lenders have nothing measurable to trust. Step number 3, strengthening credit profiles and expanding credit limits. After establishing initial credit activity, the next phase is about strengthening your profile so lenders see your business as low risk and scalable. This stage focuses on improving depth, consistency, and financial behavior. Continue using existing credit accounts every month with discipline. Keep balances low relative to available limits. Lenders prefer businesses that use credit lightly but consistently. Avoid maxing out accounts even if limits increase. Request credit limit increases only after demonstrating stable payment behavior over time. Higher limits with low usage improve your overall credit profile and signal capacity without dependence. Add different types of credit gradually. This can include fuel cards, fleet accounts, or service-based credit lines. Variety shows your business can manage multiple obligations responsibly. Maintain steady cash flow in your business bank account. Regular deposits, controlled withdrawals, and a growing average balance strengthen lender confidence. Many lenders review bank statements alongside credit reports. Avoid closing old accounts unless absolutely necessary. Account age plays a role in perceived stability. Longer relationships signal reliability. Check your business credit reports frequently. Look for missing trade lines, incorrect balances, or reporting delays. Follow up with vendors to ensure accurate reporting. Keep all business information updated. Changes to address, phone number, or ownership must be reflected consistently across all platforms. Inconsistencies reduce trust. Avoid personal guarantees whenever possible. As your business credit strengthens, seek accounts that rely on business data instead of personal credit. Limit hard credit checks by applying only when your profile clearly meets requirements. Unnecessary inquiries weaken funding readiness. This stage transforms your business from a beginner borrower into a proven credit user. Lenders begin to see patterns of control, maturity, and long-term stability, which directly increases funding potential. Step number 4, converting business credit into real funding opportunities. The final step is using your established business credit to secure actual funding without damaging your profile. Many businesses build credit but fail at this stage because they apply incorrectly or too early. Before applying for funding, review your business credit reports and bank statements together. Lenders evaluate both credit behavior and cash flow patterns. Ensure all payments are current, balances are controlled, and records are clean. Start with funding options that align with your current credit depth. Apply for business credit cards, revolving lines of credit, or trade-based financing that rely primarily on business data. Avoid products that require heavy personal guarantees unless necessary. Prepare documentation in advance. This includes bank statements, proof of business address, licenses, and revenue records. Incomplete applications often lead to rejection, regardless of credit strength. Apply strategically, not emotionally. Space applications and target lenders whose requirements match your profile. Too many applications in a short time window signal financial stress. Use approved funding for growth activities that improve revenue stability, such as inventory, equipment, marketing, or operations. Avoid using funding for unpredictable or personal expenses. Maintain low utilization after funding. High balances immediately after approval reduce future funding potential. Continue paying all obligations early. Positive momentum matters more than one-time approvals. Reinvest profits to strengthen cash reserves. Strong reserves increase approval odds for higher funding tiers. Regularly reassess your funding readiness. As your profile improves, you can access larger limits, better terms, and reduced reliance on personal credit. This step completes the system. When executed correctly, your business transitions from building credit to using funding as a controlled growth tool, not a financial risk.